Hi all, welcome back to our YouTube channel. Topic that we will have a look at today is from FRM level 2, paper 3, that is operational risk. It's from chapter capital regulation before the global financial crisis. So yeah, let's have a look. Before we go ahead, please do subscribe to our channel. It takes a lot of efforts to come up with videos like this, and please do comment, like, and share with your peers who are preparing for FRM Level 2 exam. So let's have a look. We have been asked to calculate market risk capital requirement. See, I mentioned that topic is from operational risk, but we have been asked to calculate market risk capital. So basically, all the capital calculations are kept in paper 3, that is operational risk. So don't get confused. It's from operational risk only. The one of the chapters from operational risk. So, what is the market risk capital requirement for a bank with a daily VAR over previous 60 days of $250? So, we have been given average daily value at risk for past 60 days. So, let me just round off the key information. It's an average of daily VAR over last 50 days, previous 50 days. So, that is $250. Assume that the multiplicative factor is 3 and that the previous day war is less than average daily VAR times the multiplier. So basically, this piece of information is just saying that your uh, this average times multiplier is more than a daily VR. Like other way to say this, like what has been mentioned. So it says daily VR is less than m times your average daily VR. So either ways, I mean, if you want to say A is less than B or B is greater than A, and it's one and same thing. So you have been given this information, and you have been asked to calculate market risk capital requirement, and these are the options given. So let's have a look. So formula that let's understand some formula before we do calculation. So market risk capital is basically 8% of your market risk weighted assets. So that's the main formula. But this market risk weighted assets. So let's explore this. What this market risk weighted assets are. So market risk weighted assets are 12.5 times this expression, that is maximum of previous day value at risk, or m times your average var. So that's the market risk weighted assets. So if I put this market risk weighted asset in this expression, that is 8% of risk weighted assets, what I'll be left with is, so basically just for understanding, these two are reciprocal of each other. So these, if I put this market risk weighted assets in this, these two will cancel out, and whatever will be left is this expression. So you this implies, I mean, if I just combine, if I plug two in one, if I substitute two in one, what I'll be left with is market risk capital charge is maximum of this expression. So as I mentioned that war T minus 1 is a previous day war, and this is the average VAR, and M is a multiplicative factor. It depends on bank to bank based on their observation, or sometimes it's provided by regulator as well. But this is precisely done via internal model used by banks. So what we have been given is, we have been given daily average 60-day VAR, that is $250. Multiplicative factor is 3, and what we were given was like daily VR is less than m times your average VR. So this is what was given. So there is no value. This was just the information that we were given, because basically what we want to understand is whichever is higher would be outcome of this max function. So when I say max of A and B, whichever is higher, that is output of that expression, max of AB. So in this case also, because we want to understand which is higher, So if you notice, we have been given M times average VR is higher than this. So outcome of this expression would be just M times VAR average. So that we'll see in calculation parts. So let's have a look at calculations. So as I said that market risk capital charge is this expression maximum of previous day VAR or multiplicative factor times your average VAR. So because we were given that this M times average VR is greater, so output of this entire expression would be just M times VAR, average VAR. Okay. So if I substitute MS3 and VAR average is $250. Now, most important point, let me just put this as a star. This is very important. So when we look at this formula, this average VAR has to be of average of 10-day VAR. Okay, it's not because what we were given is daily VAR. If you recollect, I had circled that information, but for benefit of all, I have again pasted the screenshot of the question wherein it says it's an average of daily VAR. Whereas in this formula, this war average has to be 10-day VAR. So you go back to your past 60 days. Each day you will have some 10-day VAR number. Take an average of that. That's this number, M times average VAR. Whereas in question, we were given daily VAR. That's the only trick. Otherwise, calculations are very straightforward. In fact, it could be a very easy low hanging fruit basically in your exam if you understand this trap well. So very important note, as I mentioned, in the formula average has to be 10-day war of past 60 days, hence it has been multiplied with square root of 10 because we want to convert from 1 day till 10 day. So because of this we have to multiply with a square root of 10. So with this, if I multiply this 3 times 250 times square root of 10, it will give me $2371.71. So if I look at that is, I mean, it was option C from our given questions. Hope you like the video. If yes, please do share with your friends who are preparing for level 2 exam and who are also planning to pursue FRM as their career. Please do share these videos with them, comment if you have any doubts. And yes, please do like because it takes a lot of efforts to come up with videos like this. And just to close the video, we stimulate the thought process to enhance learning, which definitely helps you in the exam to understand traps like this question have. So yeah, please do subscribe and thank you for staying till the end of the video. Thank you.